take a look at U.S. markets right now. We are trading down. You've got about an hour, 10 minutes to go until we finish up the trading day on this Thursday. So all of these numbers you're going to see on the heels of that better-than-expected ADP national employment report. Private sector adding 172,000 jobs last month, and that did beat the estimates of 159,000. But all of this, the precursor, the appetizer to tomorrow's big jobs number. Okay, what are we expecting? Analysts now anticipate the U.S. economy added 175,000 non-farm jobs in June. That would be down a little bit from the previous estimate of 178. I want to bring in Recon Capital Partners CIO Kevin Kelly, along with BGC Partners Chief Strategist Steve Cortez, two of my favorite guys on the show today. This is awesome. I love this. Steve, look at the market. Look at the Dow as we wait on this jobs number tomorrow. We're really close to the British referendum pre-vote, and we're almost there. I mean, if we get a good jobs number tomorrow, is the game on?
You know, it could be, although you don't want it to be too hot if you're long the market, because that could bring the Fed back into play. And I think what the market really appreciates most right now isn't so much the fundamentals of the economy, but it's just a Fed on the sidelines and not hiking rates. But unfortunately, listen, it's good news that the market has come back as sharply as it has, but I can't be optimistic right now. That last jobs number was a complete stinker, the May report. So we're going to find out, was that an anomaly, or is it perhaps the beginning of a trend? I tend to suspect that it's part of a trend. And the reason I say that, number one, wages, when we look year over year, we're struggling to hold just 2% wage growth right here. In previous recoveries, we would get up to 3-4% wage growth. The second thing, when I look at the financial markets, is I really pay attention to the staffing companies, Manpower, Robert Half. Those stocks, they're trading badly today, and in fact, they've traded really badly all year. I think that's a very bad sign for the job market overall, unfortunately.
All right. Kevin, what do you make of all this?
Well, first takeaway on the jobs number tomorrow is actually pre-referendum, right? So you need to take that into account as well. And as Steve alluded to earlier, the last jobs number was a stinker. It was worse than the most pessimistic estimation. So we could be at full employment, but I think it's a lagging indicator. So people need to focus on what the market is doing, and they should start to look at the credit markets. The flattening yield curve is really a scary sign what's happening around it. If you look at the 10-year Treasury, think of the yield started out this year at 2.25%. We're already down to 1.35%. The bond market is very, very nervous, especially about this economy. $11.7 trillion in debt globally is in negative yields. Unilever, great company, they actually issued bonds at 0%. So credit investors, which dwarf equity investors, are signaling worries.
But yet, Steve, I have to say, when it comes to the economy, and who knows what the Fed's going to do, I mean, that's, you know, you might as well just guess that the sky is green. But at the same time, Steve, you are seeing record low mortgage rates right now. We're at, what, 3.25% right now or something on the 30-year? I mean, this could be good for credit card holders and people that want to refinance their mortgages. I mean, is there an upside to this?
Right. Oh, listen, of course there's an upside, and particularly for consumers who either have debt or want to take on debt. For instance, home purchases, low interest rates obviously are a tremendous boost to them, are a tailwind.
Well, an economic boost, Steve, too. It's an economic boost, I guess is my point.
It can be, but I think we also have to look at, and I think Kevin's exactly right, though, why are interest rates this low? Why do we have a global situation of negative interest rates? In Switzerland, for instance, right now, 50-year government bonds have a negative interest rate. Cheryl, I'm not even going to be alive in 50 more years, and I won't get one dime of interest. I have to pay the Swiss government to give my heirs that money back in 50 years.
The Japan 20-year as well.
Yeah, so why are rates that low? It's because global growth is really, really challenged right here. I think global trade is in a lot of trouble. Firms do not have pricing power. The U.S. is doing far, far better than the rest of the world, but still, by no means are we a hard-charging economic train right now. And unfortunately, because of the election, I think we're going to have stalemate out of Washington for most of this year, and we're not going to get what we really need, which is tax reform, regulatory relief. That's how we can break out and have real growth.
Okay, so Kevin, you're the only one of the three of us that's going to be alive in 50 years, so I'm going to give you the last word.
The last word is that corporations are actually standing back and they're waiting to make capital decisions, especially when it comes to labor. So this job numbers could come in worse than anticipated, but you got to pick and choose in the market, and so people are going towards yield instruments. Be careful what you buy because the fundamentals have run ahead of themselves.
Well, we shall see tomorrow. Steve, Kevin, thank you.